Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. This is for the show ending Sunday, October 11th. Number one, the stock market is saying Trump is still going to win. Number two, bonds still suck. I'm saying that. Number three, levity is still much needed, and I'm saying that as well. So let's get right into the show. This is the first segment, my first take on my portfolio. Obviously, we own Hero, H-E-R-O, the ETF that invests in NVIDIA and other gaming and esports companies. And it seems like every week there's a new college that touts its esports initiative. They're sponsoring a team, they're financing a new facility, and I just flat believe this isn't a COVID trend. It's just a very strong trend. They're showing up on podcasts left and right. There are stars being created that are, Fortnite champions or what have you. And I just flat believe in the esports trend. And so we're going to play it until the charts tell me not to or the fundamentals tell me not to. But it just seems to be massive. And I want to, as always, I want to hear your thoughts, especially from my younger viewers and listeners. Please tell me what you're seeing out there, and are there other ways that we should participate? And the more back and forth we have, the more fun this is for all of us, especially me. Next take, fan mail. Charlie from New York called in and asked about a Biden victory lifting stock prices, especially given all the Fed stimulus. Does Biden's proposed spending on infrastructure, healthcare, the lessening of trade friction, especially with China, and is a Biden victory more constructive for stock market long term? And I check my biases at the door as best I can, and I really gave this a lot of thought. And I went back to a chart. Mike, we brought this up before, and I'm doing it again. This is the stock market returns for the various presidents. I only highlighted 4 in this case to make some points because it gets really noisy if I put them all up there. But bottom line is, if the stock market is down during a president's term, he gets kicked out. In this case, it's Herbert Hoover. It's the most dramatic example. Jimmy Carter is another one. But bottom line is that Hoover, in at the end of the Roaring 20s, 1928 to 1932, the crash happened obviously in 29. The low for the stock market was $42 on the Dow in 1932, and Hoover, everybody hated him for obvious reasons. It wasn't his fault, but it doesn't matter. He's sitting in the office, and everybody is feeling tremendous amounts of pain and anger, and they take it out on the president. So then we go to the longest line in this chart, FDR. Came in 1932 with the Dow at 42. The market then rebounded fivefold in the span of 5 years, and so he was elected in 32, 36, 40, 44, which is why the line is longer than all the other presidents that are here. Obviously, he's the reason for term limits. In 3 months after the election in 1944, he passed away. The public was being told his health was much better than it was. It was obviously still during the war. But the returns that happened because he came in at the low shows if the trend is up, the stock market is up. It's a reflection of social mood, and people do that, and they go to the voting booth, and they keep the incumbent in, and we see it time and time again. The top line is Clinton, the best returns of any president, period, and that's 92 to 2000. He was obviously impeached. There was a scandal you might have heard about, and but it doesn't matter. If the trend is up, we keep the incumbent in. Now, hold on to your hats, folks. Trump, whether you like him, whether you hate him, the stock market is up 50% from his election. That's the blue line that you see here. And so the stock market is saying that People feel better about their wallets, and they want to keep the incumbent in. That is not consensus thinking. That is not reflected in the polls. I don't care. I'm going to go by what the history suggests, and the stock market is saying that Trump is going to be in. So, and I know the thoughts. Okay, Trump, his lower taxes and lower regulation are good for stocks. That's what juiced it up. Biden's proposals for infrastructure will be good. So, almost anybody who wins is going to be good for the stock market. I'm just saying this is the history. I believe this fervently. And predicting what's going to get through the next Congress is way beyond my pay grade. We don't know if there's going to be a blue wave, if there's going to be, some sort of a gridlock. I'm not dazzled by any politician I have seen over the last 4, 8, 12, 16, 20 years. Winston Churchill and Abe Lincoln, I'm dazzled. Everybody else is running for second or third or eighth. So that was the long-term perspective. It's a long-winded answer, Charlie, but there's more coming. The most recent 3 months have a very good track record of predicting the president as well. It's 20 for 23, as you can see on the chart here. So if the market is up in the 3 months preceding the election, people feel good about their stock portfolios, their wealth, the economy in general. As crazy as this year has been, the last 3 months, the stock market is up 7.3%. Every time the market has been up 7% plus in the 3 months up to the election, the incumbent wins, and yes, that is Donald J. Trump, and he probably didn't approve this message, but that's what's going on. So I know that's a bit controversial and a bit out of consensus, but the facts are stubborn things. That's the history, and it could be different this time. I don't think that's the way to bet. Is the market priced for this? Doubt it. I really doubt it, and we'll see. So I hope that's helpful to your question, Charlie. And then there's more. I didn't put this in the podcast section, but because it's germane, I wanted to give it to you. So this is the Compound Show podcast with Josh Brown. He's the CEO of Ritholtz Wealth Management. I cite him a lot. I just think he's very entertaining. I think we're brothers from another mother. At 47 minutes, Josh talks about Eisenhower and Obama, and I'll tell you why. Because Eisenhower obviously had great stock markets as well. Was it his doing? No, it was the end of the war, capital being allocated to more productive purposes, the greatest generation coming back and buying washing machines and Chevrolets, like it says in the Alabama song, and he's the beneficiary. So he stayed in for his terms because the stock market is up. He didn't create it. He was there. And obviously a very highly regarded general during World War II, but I'll go to Obama, then I'll finish with my thought. Obama came in 2008 in the depths of the financial crisis. Everything he was going to do was going to look good because things looked awful. We just saw Lehman Brothers and Bear Stearns evaporate in a couple of afternoons, and people were terrified. So what do you do when you're terrified? You go for something new that looks like hope. And, of course, that was, his mantra. So Josh finishes with a thought that I want to have reverberate in your head. The presidents get too much credit when things are good, and they get too much blame when things are bad. And it's happening again. It will happen, I think, because human nature is what it is. So my take, focus on the charts, focus on groups, and let the market tell you what is promising, and ignore the prognosticators, especially the ones that are telling you to build blue wave portfolios and overweight clean energy. A lot of that has already been priced in. So let's be systematic about this as we go forward. But be ready for midnight, November 3rd, Trump wins, and it being pretty decisive. And then who knows what happens between now and inauguration. So Those are my thoughts, and I'm sticking to them. And I want to get your thoughts, ideas, services you'd like me to add. Your feedback is invaluable. I really appreciate it. I'm talking to a number of folks about newsletters and Slack groups and things like that add value to my reading that I do over the course of the week. And I hope you find it valuable. There we go. You can keep that one in, Mike. Podcast of the weeks. This is the next segment. This is the All In podcast. I talk about this a fair amount. This is for poker buddies, and I guess kind of like the idea about this, but they're for poker buddies that are very influential in Silicon Valley. Chamath Palihapitiya is the king of SPACs, if you will. David Freeberg and David Sachs are internet entrepreneurs. Jason Calacanis is an angel investor. I just like the banter. I just think it's really clever, very thoughtful, very bright people. And at 3 minutes, Chamath talks about how he kickstarted or why he kickstarted the SPAC movement, special purpose acquisition corporations. It seems like they're in the news virtually every day. And I think he gives a very reasoned explanation for why he's involved in this format, why he thinks it's helpful and valuable. I think he's one of the more reputable SPAC sponsors. I think there are some that are questionable, and I don't have the chart that I've shared in the past, but my bias has been when I pull up SPACs, I see them being very high in 07, 08 and going away in 2009. When I see phenomenon that occur at stock market peaks, it makes me nervous. It's happening again, and it doesn't mean that it's fatal and it's not going to be imminent, but I want you to be very discerning when you invest in any SPAC or any company that is acquired by a SPAC. So the next podcast is Jason Calacanis, his twist, This Week in Startups. And I was really struck by this. Again, he's a Silicon Valley insider, to put it mildly. And he had an emergency podcast very recently, and he thinks that the Apple 12 is a joke and gave it an F-. He says there's no supercycle for upgrades, very little innovation. Was very damning about it. And the first time that he is not buying a new iPhone out of the gate. Now, it's one man's opinion, but it's an influential Silicon Valley angel investor saying that the iPhone is going to be disappointing. Why do I bring that up? I normally don't talk about individual stocks. I add certainly very little to the 47 analysts, I'm making that number up, that cover Apple in depth. But some thoughts. Revenue growth is anemic. That's just a fact. 9% earnings growth is the first call estimates for this year, up 19% next. The numbers have been coming down. The PE is 37, which is lofty by any measure. The volume is picking up on the down weeks, as I show in this case. This is the weekly chart, not the daily. Goes back a long time. It's not a horrendous chart. I don't think it's going to fall apart tomorrow. But so here are my takes. With SPACs, proceed with caution, a lot of caution. If Apple rolls over, the market's going to have a tough time. It is the number one stock in the S&P. It's 7.3% of the index. Everybody owns it. And it's a $2.1 trillion market cap. So if the drum roll starts to get into sync with Calacanis, that the iPhone cycle and the 5G hype is overhyped, then you're going to see numbers come down and Apple potentially come down substantially from a 37 price earnings multiple. So just be careful out there if you own Apple, and I'll deploy my sell discipline if those triggers happen with the moving averages that I've talked about in the past. But Apple's in every damn portfolio that's out there, so I think watching Apple is going to be very interesting, and I'm curious to see what you think of the the iPhone 12 if you have it in your hands. Tell me what you think. And maybe Calacanis is dead wrong, and I'd love to hear that too. Next podcast is from The Economist Radio. And I like The Economist. I talk about them a fair amount. They're London-based, but they're certainly global. They have very good reporters all over the globe. And there's about a 10-minute segment on their most recent podcast talking about China and Taiwan tensions escalating. And I kind of had deja vu because we talked on the podcast, Mike, 2 or 3 weeks ago about China-India disputing a border, shooting, deaths on both sides that you can't really get confirmation about numbers or what have you, or the details. But so here's another one, the island nation of Taiwan, military tensions escalating between the two countries. And I just bring this up because it's one of these phenomena where it shows up on page 19 of The Economist. That isn't really, I'm making that up too. But if it progresses so it's on page 1, 2, or 3 of the Wall Street Journal at some point, I don't want you to be surprised that, oh, there's a military conflict in this far-flung part of the world that could potentially involve us and cause reverberations through the markets, especially the stock markets. So I will keep an eye on this. I ask you to, and I'd love to get your feedback, especially if you travel there or live there or have firsthand knowledge of what's happening in these two countries. I would love to incorporate those details into the show. Next segment is Reporters of the Week, and this is from the Wall Street Journal, Kirk Maltese and Will Horner, and I bring this up because it showed up in a chart, WEAT, the ETF that mirrors wheat futures that I highlighted, I think, last week. And wheat prices have hit their highest level in over 5 years in reaction to scorching weather, concerns over food insecurity brought about by the pandemic and lockdowns. And, the most active futures contract is now over $6.07 a bushel, highest close for wheat since June 2015. Wheat futures have gone up 15% since August 1st. And there's a lot of people that think the price surge could continue. Dry weather this year has whacked wheat growing areas in the U.S., Ukraine, and Russia. And I put up the wheat chart here just to highlight, I think, a good example of a process that's worked for me over the years, whereby I start with the charts, 1,700 plus in this case, but I did this specifically in healthcare forever. Find the charts that are most promising and then see if the fundamentals back those up. You always have to have both. You have to have the technical backdrop, and I want to have the fundamentals that are good but getting better and exceeding expectations in the future. And you have to go through a lot of reps because a lot of time these are dead ends. But I'm exploring wheat to see if it's worth all of us investing in. The chart is going to guide me to other data points. My hope is that our community grows, and it is. I'm never satisfied with growth, but it's good. And we all come up with off the beaten path ideas that we can profit from. And the more, this is a dialogue versus me talking like I am by myself today, I think this is going to add value to a lot of folks. My next segment is charts and tweets of the week. And this is from Howard Marks' memo that just came out. He is I believe, the chairman of Oaktree. He has made a fortune buying distressed debt. I think he's got I recommend his memos. You can just sign up for yourself anytime you want. And he shows here, and I hope you go to the YouTube channel to see this if you're listening on the podcast. But he shows the hierarchy of risk. Obviously, treasuries are virtually riskless. The credit of the United States is impeccable. And then if you go higher up the spectrum, high-grade bonds are riskier. You have to get paid more. Quality stocks, riskier. You have to get paid more. Aggressive stocks, high-yield bonds, private equity. You get the idea. And then he shows the risk-free rate coming down as it has from, let's say, the 5s to the 0s, where T-bills pay you, virtually nothing, 15 basis points on the 3-month right now. And he highlights that the whole spectrum of asset classes, the return expectations have to come down. And I think that it's I think we all knew it. But I haven't seen him put this way graphically, and I like it. So expect lower returns all along the line, and I think you have to be braced for that. And I thought it was a great illustration, and I encourage you to go to the show notes to take a look at it. Calacanis put out a tweet. Bonds are on the move. 30-year yield hit 1.6% for the first time in 4 months. It isn't a dramatic breakout yet, but it's something that I've been talking about for a while. I understand my confirmation bias, but a chart is a chart. And like I said, bonds suck. Yields are up, bonds are down, and that's in the safe part of the portfolio, which is why I highlighted. The 40 of the 60-40 portfolio is supposed to be the ballast. And if the 40 starts going down, yields go up, bond prices go down, and that 40 starts taking on losses, I just want you, at minimum, bring the maturities in and shorten up, because I just have a hard time seeing how bonds make you a lot of money over the next 2-3 years. And this is why. This is a Credit Suisse piece that came out, and it just graphically shows the 10-year Treasury yield. And, I don't think people realize that we used to have, 12, 13, 14% interest rates. They averaged 10.6% over the course of the 80s. And now we're here at 75 basis points, give or take, on the 10-year. So at some point we're going to retrace at least a piece of this, likely a third to a half, with a nod to Fibonacci. And I just think you have to be, if you're in bonds, I think you have to be very cautious and be willing to move as yields pick up. Tom McClellan cited a CNBC interview with Harvard economist Jason Furman, said that taxes can go up without hurting the economy. I don't know if he's a Biden consultant or not. It kind of sounds like he might be. Noted that taxes were above 20%. This is 20% of GDP in the late 90s, and the economy was just fine. Well, it was fine, but then the 2000s were, god-awful for stocks. So when you get taxes up to a certain point, stocks don't like it. And Tom asserts that high taxes killed the tech boom. There were other things going on as well, Y2K, bringing forward all that demand. But even still, it's hard to argue with this chart that higher taxes are bad for stocks. And stay tuned. Market concentration. Again, we all know this, but it's incredible to see this. And I'm struck by the one to the far right. The price return of the top 5 stocks is 68.7%. The bottom 495, 3.3. That's how dramatic this has been over the course of the year. It's unprecedented. I know that term gets bantied about, but I don't have another word. Now I don't have any future implications other than I think it's going to be hard for the 5 to be the leaders going forward. I'll talk about that. I've got a couple of points that came up in the work I did over the week. Federal Reserve balance sheet as a percentage of GDP. Again, I'm not a macroeconomist. I don't play one on TV. I tend to shy away from things where I can say, hey, this is going to mean you have to invest in X, and here's where we're going to make a lot of money. I'm just when you see extremes of this nature, where we were at extremes in 07, 08, and now we're blowing through them with deficit spending and Fed purchases that obviously kept the wheels on the economy for this year, but these have to get paid at some point. They represent a future burden, and I just think we have to be cognizant of them, that we're really at elevated levels. And I'm thinking back to 2018, the Fed tried to bring the balance sheet down, and the market hated it. So how they bring $7 trillion on the balance sheet down when $4 trillion was tough to do, it's going to be really interesting to watch, to put it mildly. M2 growth, money supply. Again, I'm not an economist, but this is an incredible explosion of money supply. And I bring this up, especially in the context of bonds and my bonds still suck mantra, that when you have money supply go up meaningfully, you have a 2.5% increase in interest rates. That's just what the charts have shown that I've shared in the past. Every 1% means bonds go down 10%, give or take. So I think it's going to be tough for bonds, and at a minimum, shorten your maturities up. This is, and it kind of dovetails, Charlie, with your question before, Biden versus Trump. Well, Biden has already said that he's going to reverse at least a portion of the tax cuts, corporate tax cuts that Trump implemented, and it added $18 to earnings back in 2018, 12% of the total. So if you take 10-12% away from future earnings in 21 and 22, I doubt that's priced in, and I don't think the stock market is going to like it. So that's just the facts of the numbers. And again, it could be different this time, but I really don't think so. The predicted markets, this is kind of interesting. And it goes counter to what I said before, that the stock market determines the presidential election. This is a site predicted where you can bet, in essence, on probabilities of Biden or Trump winning. And after the debate and after President Trump's COVID diagnosis, the predictive market fell apart for Trump, went down to 40%. Biden's chances now are 63% of winning, and I think it's noteworthy. I also think this is what feeds into the consensus that's out there now, where the polls show Biden with leads. Now you can point to predicted lead widening, and I'm just thinking of, if you go out and talk to a Trump supporter, did the debate and the COVID diagnosis change his or her mind? Tend to doubt it. It's going to be fascinating to see what happens over the next 20 days with the predictor markets and certainly the election. So stay tuned. But I just want to have you knowing why the Biden winning consensus is out there. Just another reason. That was from the Bear Traps report, by the way, which I think is fantastic. Sven Henrich, from the Northman Trader. I just thought this was sort of, sarcastic, and I approve it. V-shaped recovery is so strong that, and this is just, again, facts are stubborn things. The V-shaped recovery is so strong that the airlines need to be bailed out again. Consumers need $1,200 stimulus checks again, and rates have to remain at zero for years. Other than that, the economy is fantastic. Think about that phrase. It's kind of crazy. It is kind of crazy. So, again, I don't have a way to make money from that, but I thought it was funny and I wanted to share it. Jeff DeGraff is a great technician. Followed him for years, talked to him fairly often in times gone past. He is the chairman and CEO of Renaissance Macro, and I thought this was terrific. He put the timeline of the interactions / attacks of the Department of Justice on Microsoft over the course of the years. And yes, the tech bust in 2000 contributed to this, but it also shows that the government has a great way of distracting companies, hampering companies, and it made Microsoft, with other things, it made Microsoft dead money for over 10 years. So I bring that up because Congress has shown their distaste, for lack of a better word, with the Facebooks and Googles of the world, calling them monopolies, and let's start putting timelines together as to how the DOJ influences their businesses going forward. And I just think it's noteworthy, and I want to pay attention. I want you to too. Christopher Atkins, senior market strategist for Cornerstone Macro, put this together, and I just the market has never been this disconnected from the economy. And here it is from 1960. We have a negative correlation for the first time in forever. Now that could change, probably does over the next few months, but it's just another sign of the crazy times we live in. And I think that caution is certainly warranted. Sell tickets ought to be nearby, and I think having a little more cash and a little more gold, as I've said before, makes some sense. And this goes into my esports and gaming theme. Twitch is doing extremely well. There's a pun in there, but the total hours watched of live streaming of esports and gaming being viewed on Twitch is going through the roof. And I just think it's a crazy trend that I think is going to go on for a while. And The Hustle did a nice job of pointing this out, and I recommend The Hustle too. Anyway, that's the show. Thank you very much. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter @BakesTakes_ and other social media. Please use your voice memo app. Thank you. Tape your questions and email to bakes@bakestakespodcast.com, or write if you prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Have a great week. This is Bakes. And before I get into much needed levity, somber note, Eddie Van Halen obviously died over the course of the week. As you know, I play the guitar theme for the Bakes Takes podcast. I'm no Eddie Van Halen. There will never be another Eddie Van Halen. He is just a once in a lifetime talent. And go to the show notes. There's some highlights of some of the best clips of him playing live that are out there, in my opinion. And I also tweeted this week, I can't believe we went through 40 years and Van Halen never played a Super Bowl halftime show. With all due respect to the Black Eyed Peas, come on, Van Halen, really? Much needed levity. I'm going through puberty, I think. Much needed levity. The Jeselnik Rosenthal Vanity Project. I've mentioned this in the past. Great podcast. I like the banter between he and Greg Rosenthal, his best friend, college friends. Erica Tamposi's on the show. Greg and Erica work for NFL networks, and or the NFL itself, I guess. And I listen to it as soon as it shows up on my feed. I think it's fantastic. And Anthony Jeselnik, is obviously a stand-up comedian. I think he's hysterical, dark but hysterical, and recommended the Comedy Store documentary on Showtime. And I've only seen the first one, but it's fantastic. I recommend it highly. It's fascinating. It's funny. Richard Pryor, Jim Carrey, Jerry Seinfeld, Robin Williams. It is an hour that you will really enjoy. So that's what I have. See you soon. Take care now. Bye-bye.